Hey everyone, this is Elijah K. Johnson with Liberty and Finance. We are live with libertyandfinance.com and our good friend Gary Wagner from thegoldforecast.com. Gary, thank you so much for joining us today.
My pleasure to be here as always.
Well, it's great to have you, and what a better guest to have on than you today, as we're seeing kind of a rally, at least in gold. If we look back at yesterday, we saw quite a drop in both gold and silver, and now gold is recovering. I think everyone is asking the question, has gold bottomed? Is this finally we're moving back up from here? Your take on what we just saw in the last couple of days?
Well, the number I have been looking for throughout the better part of this month was $1,680. It is a technical level that when we look at a chart, we can see first, it was the exact bottom of the flash crash that occurred August 9th last year. It dropped about $60 in a matter of minutes, but actually closed back above 1,700 on that day. And then there's two other instances, if you go back about a year and a half, in which we can definitively see 1680 as being a strong technical level of support. We actually placed an order to buy on July 14th at 1681 or better, and that was filled 2 days ago. So I believed for quite some time that at least on a technical basis, if gold was to find support anywhere in the range that it's been in, that would be the most logical place to look.
So it does seem like we have seen that support. How confident are you that that will hold?
On a scale of 1 to 10, maybe 6, the key is this. We absolutely found support at 1680. We bounced off of it. We are roughly $40, $50 above that price point. The question is, how long will it continue to rise and what undertones would cause it to do that? Because on Wednesday of next week, the FOMC meeting concludes. The Fed will announce a rate hike. Odds favor a 75 basis point hike. Some say it could be as high as 100. And the key is, have market participants fully factored in next week's inevitable rate hike into current pricing? If they fully factored that in, we could see some kind of a relief rally. If they have not, or if by chance they actually do raise it by a full basis point or a full percent, we could see some volatility and further selling. My best estimate is that we had a high today of 37, and I believe that it is highly possible that we will see gold drift higher, anywhere between today's high at 37 and about 1750.
No, we are seeing, it seems like a disconnect between gold and silver, because as we've mentioned, gold has recovered quite a bit from the smackdown, you could call it, that we saw yesterday, but silver has not recovered too much. Your take on why silver is still pretty weak right now?
The answers, first of all, it is perplexing to me. So I'm not 100% clear in terms of what my observation is and my take on that. First of all, as an industrial metal, silver has been reacting and been very sensitive to recent moves both down and a slight recovery in US equities. The dollar's been on a tear. And as the dollar gets stronger, of course, it takes the entire metals complex, especially the industrial or semi-precious, which I put silver in a scenario in which it's more expensive for foreign companies to buy that product that they use to create their end product. And so it would be under pressure for that reason. I think that the dollar has been king. Has it actually hit a top? Because it reached 109 on the dollar index, and now it's down to about 106. So we've seen it come down substantially this week. The question is whether or not that is a short lull and it will return to extreme strength, or whether we will see the dollar begin to consolidate, maybe go lower, because that to me is going to be the key as to the future direction and momentum in the next moves in silver.
And why does the dollar have so much impact on this? Because it seems like it might be kind of confusing because we're seeing dollar strength, but we're seeing record high inflation, which seems to be completely counterintuitive. Can you enlighten us kind of how that all makes sense, where we're seeing, the dollar lose value against, maybe commodities and stuff you purchase every day, but it's gaining value at the same time. So how does that all work?
Well, there's two ways we want to look at it. First, if we look at it just in terms of US and Canadian consumption, of course, silver and gold are both paired in dollars. To corporations producing products overseas, they are paying for that silver based upon its dollar value. If they have an alternative currency, it takes more of that currency to buy the same amount of silver. And so that has pressured it. The primary question that you're asking, we have inflation that came in at 9.1%. It's the highest level we have seen since the pandemic, since I think about a 41-year high. And I think the real issue is this. When we look at the most recent CPI data, the number came in well above expectation. I believe that economists polled were looking for about 8.8% in terms of inflation, came in at 9.1. What that tells us is that headline inflation, in other words, inflation when you add back energy and food costs, continues to spiral out of control. At the same time, when you look at the core CPI, that actually went from, and I might have it wrong by a point or two, but I believe it went from 5.9 and ticked down to 5.7 or 5.8. What that tells us is that these recent series of interest rate hikes by the Federal Reserve have had a fractional, modest effect on reducing demand of core items in terms of inflation. But it has had zero effect in reducing the price of energy and food costs. What that tells me is that the Fed has acknowledged, and everyone can concede, that no matter how high and how fast the Federal Reserve raises interest rates, it's not going to have a dramatic impact on the fact that people need to purchase food, and that energy is an integral component of industry and of transportation, of everyday living and everyday production for a company. And so the fact that we had the core CPI tick down fractionally, but the headline CPI shoot up tremendously, tells me that the Federal Reserve is ineffective in reducing headline inflation. And it is for that reason that we're seeing certain commodities react in a kind of a funny way. And it's just the knowledge that the Federal Reserve will not be able to have any kind of great impact on reducing energy costs or food costs. And because of that, you're going to have inflation continue to run exceedingly hot. The Fed will continue to raise rates. And at some point, there is going to be, I'll call it an epiphany, by market participants who are now focusing solely upon rising rates to focus solely upon rising inflation. And if that occurs, and I believe at some point it has to, that epiphany is going to dramatically change the landscape of gold and silver pricing. We'll see a major rally ensue in gold, and you'll see a rally ensue in silver, because traders, investors, and market participants will no longer focus on rising rates, because they'll come to the understanding that they have been ineffective in bringing inflation down, and therefore they'll focus on inflation. And of course, we know that higher inflation creates bullish market sentiment for both gold and silver.
So let me kind of recap what you just kind of said there. So my understanding is that the inflation, so what the Fed has been doing is raising interest rates, but that isn't having an impact, having a huge impact on inflation, because inflation is primarily being driven by the increase of energy prices, right? And food prices and all that. So when it comes to what we're going to see in the future, even if the Fed does maybe a full point rate hike, even though, the most likely outcome is probably a 3/4 point, it's not going to have an impact on that inflation because it hasn't in the past. We're seeing that is not impacting the energy and food prices. Is that kind of what you're saying?
Correct. The only caveat or the only addition that I would say is that we have to distinguish between what we call headline inflation, which is the CPI, which includes energy and food, and the CPI core, which strips out changes in those commodities. And so we have a Fed target of inflation at 2%. That's based upon core inflation, which is running at about 6%. So we're running about 3 times the level that the Fed finds it acceptable in terms of where they want inflation to be. And that's the core level, because when you add headline inflation, you're a lot more than 3 times. Now you've got 9. So you're almost 5 times the amount of acceptable levels of inflation to get it to a acceptable core level.
And it sounds like what you're saying is there will be a shift in understanding from investors that the Fed is not going to get inflation under control, and that will then investors will move towards gold and silver. Is that what you're saying?
Yeah, basically what I'm saying is that the Fed has a couple more FOMC meetings this year. And so we still have what's going to happen in July. We then have a couple of more in which they will most likely, if inflation remains hot, implement more rate hikes. I believe that if they continue to raise rates, but headline inflation doesn't have a dramatic reduction, market participants have to come to a realization that the Fed is ineffective in controlling headline inflation, and what they are doing is driving us closer and closer into a recession and a scenario of possibly stagflation.
It does seem like that's where we're heading, or might be in right now, as we're seeing a possible recession on the horizon and, extremely high inflation. I mean, that's really what stagflation is. Now, I'd like to get your perspective on a few of these viewers' questions. Our viewers have been watching very intently and asking a few questions here. This viewer is wanting to know your perspective, because we have seen, the silver market not react as much as gold has, and some people have said, well, that is manipulation. Now, this viewer is wanting to know, does Gary believe that JP Morgan is manipulating the price of gold and silver, and how does this show up on the charts? So I know there's a difference also between what has been shown to happen, the spoofing, and actually suppressing the price. So did you want to kind of give your perspective on that?
Absolutely. Whether or not JP Morgan is actively currently manipulating or not being 100% kosher, let's say, in the way that they place orders, if they're spoofing or not, I have no knowledge of. They have in the past effectively made hundreds of millions of dollars by doing just that. I believe that the reason silver has been trading under pressure and in relation to gold not performing nearly as well has less to do with that. First of all, I have no knowledge of that, but my take on it is it's logical to assume that if we have an economic contraction of goods, not food or energy, but automobiles, electronics, and other components that heavily utilize silver. If our economy is contracting, our GDP is contracting, that means we will be producing and selling less goods than we have. And these goods, a lot of them require silver. So I believe what you're witnessing is the anticipation that there will be a reduced demand for silver in terms of its industrial applications. Whether or not JP Morgan has their hand in this one, I won't even venture to guess because I do not know. We know they've done it in the past. We know they have been fined, but those fines have been light slaps on the wrist, so to speak, which lends me to believe if you don't punish someone for atrocious actions, they tend to continue that behavior. So in other words, it wouldn't surprise me that in some way, shape, or form at certain times they have their hand in the cookie jar, so to speak. But I don't think that what we're seeing with the reduction of demand in silver taking the price lower has to do with manipulation as much as the perception that there will be less of a demand for silver as an industrial component in the process of manufacturing goods that utilize silver.
All right. And for our viewers just joining right now, we're with Gary Wagner of thegoldforecast.com. We have another viewer's question, and I know you have touched on kind of where you're looking for silver to go in the coming months, but if you can reiterate for our viewers. So this question is, this is the 9th consecutive weekend that the silver spot price has dropped. Does Gary think this may continue, or is there going to be an event to turn this around?
I believe that we've seen silver come under pressure, absolutely more pressure than gold on the way down. And as we saw gold bounce up, silver actually closed down, has to do with traders looking out 4, 6, 8 months ahead of time, anticipating that there will be less need or less demand, for industrial silver because there will be a contraction of the manufacturing companies' products that use silver. In other words, if it's anticipated that they're going to use less silver 6 months down the road because the economy is contracting, the price would naturally go lower. And I believe that that is the primary crux of what we're seeing in silver currently.
All right. Well, Gary Wagner, what are some of the key takeaways that you think viewers should be aware of, and how to really weather, the markets going forward? It seems like it's a pretty rocky ride the last few months, and really since the beginning of the year.
It's been an extremely rocky ride. Take, for example, gold. We saw gold open at about $1,800 at the beginning of January, and then by the middle of March, hit the year's high of $2,077. From that point, that's a rise of about 13%. It has dropped from 2077 to the low of the flash crash 1678 by 19%, or $399 in under 4 months. So we've seen an extremely rocky road in terms of extreme highs and then extreme lows. I think that moving forward, it's going to be tied to consumption, the economy, whether we get a real economic recovery, and if we can get one with interest rates being ratcheted higher on a consistent basis, because the Fed had a 25 basis point rate hike in March, followed by a 50 basis point in May, 75 in June, and now another 75 in July. They've not only raised rates over the last 4 consecutive FOMC meetings, assuming they do that next week, but they have increased the magnitude or the size of that interest rate hike, either by doubling it or 25% in the case of 50 to 75 basis points. That has to have a very harsh reality when it comes to having a vibrant economy, because when it costs more to borrow money, it takes anything that any corporation does, as well as any household, and makes the cost of living or producing things higher. We won't see things turn around until we see a normalization of interest rates and until we go back to having a robust period of economic growth.
Which it seems like at this time very difficult to have either one of those.
It is difficult, but I don't believe it's impossible, because when we consider how strong the global economy was prior to the pandemic days, as we came out of it, we had all the pent up demand that came from that isolation. Then we went into the war in Ukraine, really complicating supply chain issues. But for the most part, the supply chain issues that were prevalent a year and a half ago have really worked a lot of it through the system. Boats are coming in, products are being delivered. The problem is, as interest rates go higher, it really lessens the demand for those products, and that's what's got to change. The other thing that we need to be aware of is we're starting to get into very dangerous territory in terms of having Fed funds rate at 3 to 4%, even 2.25%. And the reason it's dangerous is, I believe at 3.5%, the cost of servicing the interest only on our national debt, which has swelled tremendously, is in excess of $2 trillion. The Federal Reserve is well aware of that. They can raise rates, but they cannot maintain rates at an exceedingly high level without it having immense and detrimental effects on the United States being able to service its debt. And that opens a whole new Pandora's box or can of worms. So although they're raising rates, I think that as quickly as they think they possibly can, they're going to want to bring them back into alignment and not keep them elevated. And those are the things we need to look for, because as soon as rates begin to contract, as soon as we see rate reductions instead of hikes, we will get a burst of economic activity. And that's the moment in time that we're all hoping for.
All right. Well, Gary Wagner, thank you so much for your time today. Where can our viewers find you if they're interested in learning more?
Absolutely. I have a website, thegoldforecast.com, one word. You can read my daily column on Kitco Media. It's called After Hours. It's published at around 6 o'clock every day, Monday through Friday, EDT, as well as our YouTube channel, thegoldforecast.com. And we publish our weekend review video and report at no charge for anyone that wants to watch that every Friday. So that's the best way to see what we've done and see if you find value in what we have to say.
All right. Once again, Gary, thank you so much for your time, and God bless.
God bless. Have a great day and a great weekend.